Hello and welcome everyone to the Closing Bell Show, where you can invest with the best. This week, we had former Bureau of Statistics employee Joseph Politano on. He takes us through the current macroeconomic climate in the US, what the job market really looks like, and he gives us his thoughts on whether or not he thinks we are headed for a recession. If you're enjoying our content, be sure to check out our full content library at gems.closingbell.co.
I thought the best place to start would be to get the ABCs of Joe. Obviously, you're a financial writer. You're a great financial writer, and I've been keeping tabs on some of the work that you've been doing over the last few weeks as I've come to learn about you, and that's why I reached out and I thought, wow, I need to have him on the show alongside all these other great financial writers just to add a bit of depth. So we have a lot of people who come on and talk about stocks, but you're more macro specific. And that's something we haven't had on yet. So someone who can talk broadly about the market, and give us their insight. So maybe we'll start with that. We'll start with the ABCs of Joe, and then we can jump into some more questions I have about some of the more recent articles you've written.
Yeah, so I'm Joseph Politano. I was an employee at the Bureau of Labor Statistics here in DC. Before that, I was at the Peace Corps abroad in Uganda, and I studied econ at the George Washington University. And I've been writing Apricotas, which is my newsletter, my Substack, about mostly deep dives on macro indicators within the US, and a lot of data releases here and abroad, and trying to make sense of the data in an increasingly complex global economy. And so I've been writing now for about a year, and it's become my full-time job very recently. So I'm very excited about that. And I'm very thankful to be on the show today. And I'm very thankful for people who've been reading for a year or even just for a couple months. It's your first exposure.
Yeah. Are you a investor as well? Or are you mostly, is your primary kind of job here to provide commentary on the markets?
I view my job as to sort of interpret this data in the best way I can, and then leave how you react to that to you. So if people are reading this data and they say, hey, this is how I'm going to change my investment thesis because I think, maybe this is the reason the US economy is better than I thought or worse than I thought, or these sectors are going to be harder hit than I thought, and I'm going to evaluate that. But as policy, I believe that my comparative advantage is not in investing specifically; it's in interpreting this data, and then other people can take that and do with it as they may.
Yeah. Now, if you were to think of the top two people that you really admire in your space, let's call it investing or in the macroeconomic environment, economists perhaps. So if you think of two, who's the second person that comes to mind?
Who's the second person? Okay.
Yeah.
I am a big fan of Rory Johnson. If you know him, he's also on Substack. And he writes Commodity Context, which is a newsletter about like big data analysis, specifically on oil markets, but also incorporating like natural gas and some other commodities. And that's obviously been like a crazy market to watch over the last like year or 2 years, even, as he went from like a total bear market in 2020 and early 2021 to having this like weak response in the US and like rising oil prices that everyone was trying to decipher, to the war in Ukraine and the impact there, where now energy prices in Europe are skyrocketing and oil and energy prices in the US are very high. It's very funny in retrospect because one of my refrains that like COVID has broken everyone's brains on data, where if you had told me that natural gas spot prices in the US would dump, I'd be like, oh my God, that must have been a disaster. Like, I have what could have possibly caused this? Things would be falling apart. And I'm looking at like US natural gas prices basically doubling. And I'm like, it's fine. Compared to what's going on in Europe. Like, oh, I'm so thankful to be in the States right now.
Yeah.
That's one thing where a lot of I think the big story that's been underreported is maybe a lot of data people relied on kind of broke down during COVID because collecting it was harder or interpreting it was harder or something that happened in the background. People didn't notice that made it less reliable. And that's part of what I see the value for cadets.
100%. And that's exactly what I see the value in it. Too. Now I'm on your Substack as we speak. I love the branding. You wrote an interesting article called "Are We in a Recession?" I was thinking that maybe you could break this down to us in layman terms. Starting from as simple as what is a recession in your mind, but then also could you teach us a little bit about tracking recession risk? So you talk about recession risk, and you talk about how to measure recession severity as it happens. So maybe you can take us through the whole life cycle, because some of the listeners may not be completely aware, like how you define what a recession is. I know we talk about recession in terms of 2 negative quarters of GDP growth, but maybe there's other factors that we don't know about.
Yeah. So it's funny because I think there's a general consensus of layman psychological interpretation of a recession, which is that if the economy is visibly worsening, and there's like a Poindextery economist definition, which is, are these metrics of real output, real manufacturing output, real employment, real GDP declining? And very clearly in that first bar, is the economy bad? Do people feel bad if the economy is met basically everywhere because of how rapid inflation has been, because of real wage declines, because of increases in the prices of like food and energy and other necessities? People are understandably in a lot worse financial situation. The Poindextery economist definition of a recession is still kind of up for debate. So the 2 quarters of negative GDP thing is important. And a lot of countries outside the US have a hard definition there. But in the US, it's not really a hard definition. So like the 2001 recession actually never had 2 consecutive quarters of negative GDP growth. And in a situation like in the 1970s, where you had big population growth, you could have like lowering living standards, but still positive GDP growth for over several years. And on top of that, we got data today as of recording about gross domestic income, which is supposed to be exactly equal to gross domestic product. Basically like 2 ways of measuring the economy from different angles, but it should be the same picture. And as of right now, they're very different pictures. So if you're looking at gross domestic income, it's saying that there's a lot of inflation, that growth is still low, but it's positive, and that it's a slowdown more than it is a recession. If you're looking at GDP data, basically saying inflation is lower, it's going to be lower than you expect, but still pretty high. That real output has been declining fairly significantly, and that like we're either near a recession or there's very high risks of one in the immediate future. And so on that respect, it really depends like what source are you going to believe? And they're supposed to be equivalent. And I think the evidence is that gross domestic income tends to be better as like a live indicator, but even that's not like good. Gross domestic income's in like a bad place. If you're looking at it saying, well, this means the US economy is doing well, on the flip side, it means inflation in the US is probably going to be worse and hold on for a bit longer than if you were looking at GDP.
Yeah.
But the big metric, the big metric, if you think about it, if you're like, what is a recession at the very most simplistic level? Recession is when people lose jobs, and on that front, we have maybe seen some stagnation in employment levels, like 4 or 5 months of like slower employment growth, especially if you look at surveys that track unemployment and not surveys that track the number of workers, but definitely not a recession yet based on employment. And the problem with that is that usually once people are losing their jobs, it's already, if you're trying to look for one ahead of time, you're looking at the employment rates, you're going to miss the boat.
Mm. Mm. And in terms of recession risk and measuring recession severity, well, can you first define what it means to track recession risk? Because that's something you wrote about. And we'll start there, and then we'll talk about measuring, I guess, recession severity on the back end of that.
Yeah. I think I made a joke there, is that the economists are famously really bad at predicting recession.
Mm.
And some of that is for understandable reasons, because if you like knew a recession was coming, you'd stop it. And then it wouldn't happen, and then your prediction's wrong. So what are we doing here? But there are some indicators you can look at that provide pretty good baseline assumptions about like what do businesses think the risk of a recession is.
Mm.
And so the indicators I really like to look at is high yield credit spreads. So you're basically saying, were these businesses that are very risky or have distressed debt, or maybe the least profitable, the least successful businesses, what's the chance that they default, they don't pay back their debt? And, investors in these companies are very attuned to recession risk, because at the slightest downturn, these companies are going to get hit the hardest. Those were very historically low in 2021. When the Federal Reserve started raising interest rates, they started going up, which is, kind of the intended goal. If you were listening to Jerome Powell, he was saying we saw financial conditions getting worse. We were happy about that because they view financial conditions were getting worse. People spend less inflation. We're going to get that under control. Those spreads peaked in June, and they peaked at a level that would be like the worse than a 2019 slowdown, but not as bad as a 2016 slowdown. 2016 was maybe like a mini recession, like concentrated in manufacturing and some durable goods and some investment stuff, like not a broad slowdown, and not many people lost their jobs. 2019 was like even less of a slowdown than that. So it was somewhere in between. And since that, because oil prices come down a lot in the US, and like the energy picture has gotten a little bit rosier, those financial conditions have eased. And you view that as a reduction in recession risk. And I think that recession risk probably peaked in June, but it's contingent. If inflation's still really high, if inflation is still out of control, the Fed's going to have to keep raising rates. You're going to have to see credit spreads keep worsening, recession risks keep increasing, for them to try to get under control. And so, like I said before, we were talking about the GDP and GDI numbers. Both of those are definitely in slowdown territory. One statistic I like is, it's very complicated. It's a very nerdy one. Real final sales to private domestic purchasers. And that's like a very nerdy way of saying what's the total of what people are consuming in the economy and what businesses are investing. And that number very, very rarely is not positive. So almost always people are consuming more and businesses are investing. That number hit 0 last quarter. And it very rarely hits 0 outside of recession. And again, the caveat is that GDP numbers look weaker than the GDI numbers, but that still, to me, is a very scary indicator.
Yeah. When was the last time that number hit 0? Out of curiosity.
I think it was 2007, 2008. I can look this up right now.
Yeah, go for it. Yeah, you go for it.
A little more difficult than anticipated. Yes, it was Q1 2008. The last time it was basically 0. And then before that, it was like Q2 2001.
Yeah. And just quickly going back to your point on the defaults, what was the name of that? Was it the high yield credit spread? Was that the index that you were tracking for that?
Yeah, there's different ones. I like Bank of America's. It's Bank of America and ICE, the financial company. And what they do is they have an option adjusted spread. So they're adjusting for the fact that like sometimes these are callable or whatnot. But if you had looked at that, the spreads reached like the lowest point of about 300 basis points in like late 2021.
Yeah.
And then they peaked at like 600 basis points in July. They've been down since then. They're down now to about 450. So obviously these things, it varies day to day how people are feeling about the economy, but that 600 number would have been the highest since 2016, excluding the early pandemic. Obviously the pandemic, the like March 2020, every data indicator looked really bad.
Yeah. Now on what's happening now in the States. So in your report, you mentioned official data showed the second consecutive quarterly decline in US real gross domestic product. Output declined at an estimated 0.9% annualized rate. So that's 2 negative quarters of negative GDP growth. What's the outlook for the US? Like, firstly, are they? Would you consider them to be in a recession? And two, what's the outlook for the next 18 months? What do you?
I would say, as of right now, I would not make that call that the U.S. is in a recession. I think the data is too mixed. That it's clear that it's a slowdown, a persistent slowdown of maybe 6 to 9 months, but it's not outright contraction. I think the big risk is that you're saying everything in the real economy points to a slowdown. But if you look at, total consumer spending, if you look at total consumer income or business profits on a nominal basis, on a dollar basis, they're increasing really rapidly. And so if you looked at, say, gross domestic income is a good example, basically with the total amount everybody in the economy, that increased at 10% annualized rate last quarter. And if the amount that everyone's earning is increasing by 10% and the real economy is not growing, that's 10% inflation. I think the forecast would probably be that number, that earnings number comes down to say 5% by a year from now. And the real growth number picks up to like 1-2%. So you end up with, if you look at some of the data on inflation forecasts, it's like the forecast 6%, 7% by the end of this year. And then by this time next year, be like 3 or 4%. Those numbers are very bad by pre-pandemic standards, but they're less bad than we have. And so I think there has been a bit of a corner turned. So if you look at like I said, oil prices coming down significantly. If you look at car production, which was a really big issue in the US, where we had a semiconductor shortage and then a shortage of cars, and that pushed inflation up, that looks like it's going to be alleviating. But it really does all hinge on, does inflation improve in the way that the Federal Reserve wants and really quickly, like within the next year or so, because it doesn't improve. And right now you have like peak interest rates by the end of this year, by the end of 2022. If it doesn't improve, that means you have to push interest rates higher, and that's going to increase the risk of recession.
Yeah. Switching gears slightly, you wrote about mortgage rates, and you wrote that the movements in mortgage rates are unique in modern American history for both their size and speed. So this is a question that you kind of answered in that report, but I thought I'd get your first-hand take on it, which was what happens after mortgage rates hit a 13-year high?
Is the answer that nobody builds homes. My favorite thing is to look at, so people care about the price of a home, but principally if you're buying a home in the US, you care about what's the monthly payment on the 30-year mortgage. And Redfin has this good thing where they track, like, if you got the median interest rate and you bought the median house, what would your payment? That number's up like 50%. And now really, in my mind, that's not sustainable. either you have to see prices decline so that the payment gets back to something normal. It's not like people suddenly start earning 50% money. um, so either interest rates decline so that the homes are affordable at something close to current prices, or prices decline so that they're affordable at current interest rates. The difficulty in this like immediate moment, or maybe like the next, let's say, if you believe the current forecast interest rates peak in say early 2023, and they start slowly coming down from there. If you believe that forecast, what it basically means is that mortgage rates are going to stay really high for the next 6 to 8 months, because repayment risk is a serious risk for mortgages. If someone takes out a mortgage and then interest rates go down 6 months later and then they refinance that mortgage, well, the original lender, basically lost that asset. They got the cash back and they were trying to lend the cash out. Now they have to lend it out at a lower rate. They're upset about that. And so rates on mortgages have increased more than rates on treasuries, on US government debt. And they're so high that if you look at like new housing starts in America, they're down 25% for single family, which is just a tremendous amount, something we have not seen since like 2005, 2006.
But there's nothing structurally wrong like there was in 2006, 2007.
There's nothing structurally wrong, principally because almost all the mortgages now are backed by the government sponsored enterprises. So a lot of the companies that you think like create mortgages, really what they're doing is they're what's the best way to say this? They're processing the mortgage, and then they get it certified by Fannie or Freddie, and then it gets sold immediately. So they don't actually have any exposure to the mortgage as an asset. The only exposure they have is fees that they generate off of originating these mortgages. And because nowadays, like the adjustable rate mortgages, which really screwed people over in 2008, 2007, 2008, are basically all gone. And because a lot of people have more equity in their house than they did in 2008, I think the risks of the housing market are principally about risks to home builders more than they are home lenders. That makes sense.
Yeah. Yeah. Do you have any, and I'll jump into another part of what you wrote about, which is really just about the jobs report. But I'm curious to get your thoughts on if you have any on, I was reading some articles about used car, there being a used car problem in the States, and people sort of leveraging themselves up on buying all of these, I don't know Carvana very well, but all of these kind of leases, the car leases. Do you have any info on that? Have you done any research on that and how that's impacting people's ability to pay debts in the context of their car leases or otherwise?
Yeah, if you look at delinquency rates on auto loan, they're like increasing, but they're still way below where they were in 2020, which I think is consistent with the idea. If you had bought a car in 2019, bought a used car in 2019, it's probably increased in value by something like 30 or 40%. So even if you were per se underwater the loan, it can be pretty easy to basically borrow against that again. And nobody bought a car. Nobody bought any used cars in 2021 because there was massive shortage of new cars, which trickled down to nobody selling their used cars. So I don't worry about that from a like systemic liquidity perspective, also because auto loans are a much smaller share. And people generally, people don't buy cars with the expectation that they'll increase in value. So there's a lot less like levered trading of cars going on. But I do think there's a worry because of how essential cars are to infrastructure and life in America, that them being so expensive is like a real economic drag. The good news on that front is in 2021, car production was sitting at maybe 75 to 80% of normal levels. And now it's back to like 100%. In practice, that means there's still like 4 million or so missing cars because these are cars that should have been assembled in 2021 or 2020. They never were. So there's still a shortage, but it's a shortage that's getting better. So if you look at like the Blue Book or Black Book car valuations over the last like month or 2 months, they've been decreasing pretty substantially, decreasing by like 4 or 5%. And 5% a month is like crazy movements. Again, this is one of those things where everyone remembers a few years ago when it was like 20%, but 5% a month compared to before the pandemic, it's a crazy movement. And that should hopefully help with inflation in the US. That should hopefully help with like real output too. I was doing the math on this. If you've got used cars back to normal prices, that would shave like 1.5% off inflation. If you got new cars back to normal prices, that would shave like another percent. Getting new cars back, obviously a lot harder. The car companies, I saw an ad recently where I was just so baffled by this. They were like, oh, buy the 2023, whatever model car it was. And I wasn't paying attention. And then it had like at the end, it had the speaker talking really quickly and being like, the 2023 cars are out, by the way. We don't have any on the left, but you can reserve a waitlist spot for 2024. I was like, oh boy, why are you advertising the 2023 car if you're out? But that's just like, this just goes to show how bad that shortage is. So it would take a lot for new car prices to come down. Even if you ran, because if you ran the factories at 100%, and that's presuming that you could get every input part, fix every other part of the supply chain, you get all the imports you want from Mexico and China, you run the factories at 100%, it will take you a year and a half to catch up.
Yeah. Now I'm going to switch gears slightly. I do have a couple of other questions, but we'll jump into the jobs report first, and then kind of the lingering questions I'll ask at the end. So, you published this article on the jobs report. So every month, the Bureau of Labor Statistics publishes an update on the employment situation in the States, colloquially called the jobs report. You wrote a piece on this called Labor Market Mystery Hour. It's a very nice title. Could you explain the current state of employment in the US and where you think it's heading? Like, is it, because we spoke about this at the beginning and you mentioned that, unemployment isn't so bad. It's slowing down, I think you said. Could you add some color to that and where you think that's heading over the next kind of like 12 months and whether that's a problem for the States?
Yeah. So there's the interesting thing in America is you have two separate surveys when you're collecting jobs data. So on the one side, you call businesses and you ask them, how many employees do you have? And the other side, you call people and you ask them, do you have a job? And those measures should line up fairly well. Obviously, expect you're calling right businesses and the right amount of people, and you're doing this all in a very careful way, which the Bureau of Labor Statistics does. Those numbers should approximately equal. Over the last 4 months, if you look at the business survey, you would basically say this is like roaring, hundreds of thousands of jobs added a month, millions of jobs added quarter. This is such strong growth that would almost be inconceivable before the pandemic. If you look at the household survey, you basically say this was pretty strong growth for a year and a half, and then in March, basically all stopped. So in 4 months, there's been like zero growth. And that to me is worrying because if you look at like the percent of working age adults have a job, that's like a good leading recession indicator. It tends to stall right before a recession, and it stalls for a long period of time. So if you look at 2001, it stalled for I want to say 9 months before the recession, I believe 2007. So basically the full year. So I get worried that it's stalled for now, like 4 months.
Mm.
Um, but on the flip side, like the payroll survey is so strong. Business survey is so strong that you almost can't discount it. So I went through and I was saying, is it possibly people working 2 jobs, which it definitely is somewhat? Is it people leaving self-employment? So in the US, if you were like working for Uber, you were self-employed, and then you work for an actual business. You did get a job legally. You had you were self-employed and you got a 9 to 5 job, but that's counted as an additional job. It's a little bit of that. But the majority of the gap is like unexplainable. So you have to hope that it's either, um, something that's being missed when you're calling people and asking them to have a job, or that it's explainable through something like higher immigration. It would boost the jobs numbers, would be good. That's good for America because it means, people are traveling again. They're coming back to the US. You had a shortage of a lot of summer workers because people weren't allowed to come in due to COVID. So that would be good, but it would still be worrying that the number of people with the job has kind of stayed. And so I was tentatively trying to suss out what was going on there. Then this week, we got another update from the Bureau of Labor Statistics where they basically said they do revisions occasionally. So they do the survey of this, and then they check back in later with more comprehensive data, update things. And they came out with an update and they said, actually, there was like 500,000 more workers than we thought in March. And I was like, so so the gap is even bigger now. And so it really depends. It's just like, my thesis that a lot of things going on in the US are very mixed. And it's really hard in real time to know what's going on. But right now, I think it's clear for both surveys that like the job market is still fairly strong. The difference is a job market that's like stagnant versus one that's growing. And then the GDP data is one that's like slowly growing versus one that's contracting. So if you're looking at the job data, both of them, you're more optimistic. You're more optimistic than if you were looking at like the output data in the US.
Yeah, 100%. Thanks for that, Joseph. Now, just last question, and it's more of kind of like a zoom out question. I was reading a Ray Dalio came out with a book. I forget what it's called now, but it was something about it was about tracking kind of the cyclical nature of empires throughout history, and how there's sort of this pretty consistent growth pathway, and then they kind of top, and then they start to decline, and then someone else comes up after them. And he talks about it a lot in the context of the US and China. Do you have a view on any of that? Like, do you have a view on where the US sits in their relationship and in their competition with China as being kind of the world economy? Obviously, the US is still kind of the leading player here, but China seems to have a foothold, particularly in manufacturing and ability to disrupt supply chain and logistics. And everyone's manufacturing there. So we're seeing a lot of people come and manufacturing back home, domestic manufacturing sort of coming back a little bit more to protect themselves. But do you have a thought on, or do you have an opinion on that relationship?
Yeah, this is very capital and macro question.
Yeah.
I was talking to someone about this yesterday. I was saying, I think if you'd asked me that question in 2021, I would have given a radically different answer than I'm giving today. And I think it's remarkable. But you know this, anyone who's like paying attention kind of knows that there's so much going on right now. There's so many different messes that people kind of forgot that all the messes that are going on in China, right? Starting with like Evergrande and the major property developers having financial troubles. Now you're into several months of lockdowns, into this major drought, into these power shortages, into this like complete collapse of home building markets within China. So I think, their position looks a lot weaker than it did even a year ago, which goes to show like how quickly things can change. From like a capital and macro perspective, my position on this has always been that the key thing is, how does like the dankest bargain work itself out? The idea that, okay, we've promised very high, GDP growth, very high growth in living standards in exchange for, total control over political and social life. And I think that bargain, it starts to look a lot worse when they're not delivering on. Um, and I think the big worry, if you're, um, from a macro perspective, if you're like a China bull, the big worry for them is demographic, is that they have an older population, a population that's going to start shrinking if it hasn't already, with like lower immigration rates than the U.S. And the U.S. still will have a growing population while most of Europe and Asia has like a shrinking population. But that to me, I'm not someone who believes demographics is everything, but that to me is like a very important thing that I think gets overlooked in that discussion.
100%. Joseph, thanks so much for coming on, man.